And so before we get into that, just a little bit about us. AOA has been around for over 40 years. We're one of the largest, we're the largest individually organized group of apartment owners here in the state of California. And, even for anybody who joins the first year, there's a 100% money back guarantee. So if you're not a member, we encourage you to join, and I just want to welcome all of you members. It always surprises me the high caliber people that are members. I don't know why that surprises me. It's people who are interested in learning are the ones that join, but always just incredible to meet you throughout the week as things go on, and week to week, and as we go along. And then speaking of that, we do this Saturday. There's actually two different things going on at the same location at 9 a.m. This will be in Arleta. It's right off the 5 freeway. That's the east part of the San Fernando Valley, coming off the 5. We're going to be there at 9 a.m. for a political action roundtable. And so we want to welcome you to come to that. And then at 10 a.m., that's just going to be a short meeting. 10 a.m., they're going to have a Meet the Candidates event at the same location in Arleta. It's just off the 5 freeway. And so that is important just because with Nury Martinez being ousted, that replacement person is going to be important. So I think it'll be good if we can kind of have a presence there at that meeting and ask questions. You'll be able to write questions down on a sheet of paper, and they will read those questions. And so be thinking of good questions. Come out and join us for both of those. And then also, next week, you really have to scroll on your phone. If you just see one event for next week, then scroll, because there are tons of things happening. Next Thursday, literally, there's 3 different events. We have Dennis Block, who will give a great update for the LA area. And if you missed it, last week we had an update for the Bay Area with Attorney Richard Beckman. And so next week it's going to be Dennis Block covering LA County, and then we're going to have Franco Simone covering San Diego, I believe, yes, at 1:30. And then at 3 we're going to have yet another one, and it's about how to handle no-fault evictions. And so no-fault evictions so 3 different events next week. It's going to be a lot of fun, I think, and we're going to learn a lot. So I want to invite you to go to that. And if this is the kind of content that you like, you can subscribe to the AOA USA YouTube channel. But then also on the website, if you're already a member, you're probably already on the mailing list. If you're not receiving emails, then definitely let us know. We'll get you back on there. But you can also join the e-newsletter list for free, even if you're not a member, and get updates. And you may not get everything that a member gets, but pretty close. And then also just want to say that as we go along here, we'll collect questions, and then at the end we'll answer those. And so if you're on the AOA website right now, there's a blue help button on the bottom right side. You can actually put questions in there, and they'll funnel those questions over to me. And anyway, so that's all the events. And closed caption also, you can get that live on Facebook, or on our Facebook page there. So hope you are able to see that there from Facebook. And also, just a big thank you to our sponsor today, Real Estate Transition Solutions. They have 3 offices on the West Coast, including 1 in San Francisco, and they do over $220 million yearly in replacement properties, and they are your DST experts, and that is what they do. So we're excited. So thank you again, a thank you and a shout out to them. And then from Real Estate Transition Solutions, we have the partner, and he's also in charge of marketing, education, operations. Been with the company for at least 6.5 years now. He grew up in the industry, the real estate industry, and so he brings a lot of knowledge that'll be very evident to all of you. And so it's my pleasure to welcome to you today Austin Bowlin.
Thank you for joining for today's presentation, and thank you, Jeff and AOA, for hosting today. As mentioned, my name is Austin Bowlin. I'm a partner at Real Estate Transition Solutions. We've been helping AOA with educational content as it relates to 1031 exchange strategies and replacement property options for some time now, so there may be a little bit of familiarity here. What we're going to talk about today is specifically how one selects replacement property and the replacement property that's going to be most consistent with their objectives when doing a 1031 exchange. This is really built off of the premise that often people are reacting in a 1031 exchange given the tight timeline and changes in market conditions and the like. Whereas we're much more proponents of approaching it from an intentional and strategic standpoint and making sure that that exchange ultimately moves you closer to where you want to be from an objective standpoint. One of the replacement property options that we'll be touching on in brief today is the Delaware Statutory Trust. That's an ownership structure that we'll dive further into. It both qualifies for 1031 exchange purposes, but is also a registered security, which means that as a Regulation D security, in order to invest in the Delaware Statutory Trust, or DST as they're commonly referred to, one must be what's considered an accredited investor. Typically, that means having a net worth in excess of $1 million, not including the value of your primary residence. But alternatively, you can be an accredited investor by having annual income in excess of $200,000 as an individual, or $300,000 if married, filing jointly, or by holding a number of professional licenses or certifications. Quick background on our firm, Real Estate Transition Solutions. We're a real estate advisory firm that really serves and focuses on serving property owners who are navigating what we consider to be the transition from the third to the fourth quarter of property ownership, a period of time in which very commonly property owners are looking for ways in which they can reposition their investment real estate so it delivers higher income, may not be as management intensive, ideally completely passive for many individuals, wanting to lower their overall risk profile by diversifying their asset base, starting to give more emphasis to estate planning and having that increase in terms of priority of their objectives, thinking about how do we transition to a surviving spouse or to beneficiaries and do it on a tax efficient basis. So that's really the profile that we work with, is individuals who are moving into more of that retirement mindset and staging for that fourth quarter, but specifically property owners that are in that place. The firm was founded just over 20 years ago by my father, Roger Bowlin. I joined about 6.5 years ago, a CPA by background, and we have a whole team of advisors who work directly with property owners. We have an in-house due diligence department that exclusively focuses on underwriting both institutional real estate firms, companies, sponsors, as well as underlying individual properties as well. Marketing and education team that produces much of the hopefully very helpful educational content that we put out, and then also our client services and investor relations team. What we're going to cover today is a quick overview on 1031 exchanges, very brief, just to make sure everyone has that foundational knowledge, that baseline knowledge. And then we'll talk through the process of a 1031 exchange, looking at it from more of a big picture standpoint. And we'll extract from there 2 stages that we're really going to focus on today. And that is identification of objectives and then using those objectives to evaluate replacement property options. So with that, the 1031 exchange is widely known, and it's widely known because many consider it to be the most advantageous section of the tax code. In short, what it allows for is an individual or entity to sell investment real estate, property that was held for business or investment purposes, and provided they meet the IRS's requirements and deadlines and reinvest all of the sales proceeds, they can defer all of the tax that would otherwise be due upon that sale. Now we're talking about not only capital gain tax on the appreciation, the increase in the value of that property while it was owned, but also depreciation recapture tax at 25% federally, net investment income tax at 3.8% federally, and state income tax, depending on the location of the seller and then the location of the property itself. So when we're looking at a California situation, we're talking about a marginal tax rate that could be as high as 43.1% when all taken into account. All that tax that would otherwise be due can be deferred, and one can acquire new property, what's referred to as a replacement property, as long as that property is like kind. And often people, understandably so, because it's a little bit of a misleading term, view like kind as saying, oh, I'm selling an apartment building, I'm selling a single family rental, I need to acquire the same property type. In reality, the IRS's definition of like kind is quite broad. It's any property held for business or investment purposes. So you can sell that apartment building and you can exchange into an industrial property, or you can sell that single family rental and exchange it into self-storage property. There really are no limitations among property types, provided that it's not personal use property, either your primary residence or a personally used vacation home. Now, when we talk about the 1031 exchange process and timeline, we really break it down into 9 steps. And often people will immediately jump to the IRS required timeline of, upon the sale of the property, 45 days to identify replacement property, followed by an additional 135 days to close on the property. As an exchange advisor, we look at it more holistically and say, we need to have a plan going in to the actual transaction itself. And we also need to make sure that there's this baseline understanding so that an exchanger, a property owner, is not going to get blindsided thinking they can do something and then finding out that that's actually not allowable. What it really starts with from our standpoint is, one, understanding that tax liability, determining whether that is sufficiently large to warrant performing a 1031 exchange in the first place. Then education on the rules and the steps associated with the exchange. And then we go into objectives and evaluating replacement property options, which is what we'll be diving into and focusing on today. From there, once all of that is in place, all that front loading, if you will, that sometimes happens a year or 2 years before an actual sale and exchange. There's really no need to have that be in the weeks leading up to the decision to sell a property and move into a 1031 exchange. You can absolutely front load that, and we encourage property owners to do so all the time. But from there, now you can move into the process of actually selling your property. And then once sold, the exchange is funded and you have 45 days to identify the replacement property, 180 days total to close on that property. And then you want to make sure your tax preparer, your tax advisor is aware of the transaction so it can be reported appropriately. Now, why we focus so much on objectives is because evaluating and determining objectives really establishes the framework through which all replacement property options are evaluated. And it's important to understand that there are a near indefinite number of replacement property options. When we talk not only about actual properties themselves, but even categorically from the standpoint of there are properties that are intended to have a value add investment thesis versus stabilized properties. There's properties where there's going to need to be large capital improvements made, whether it's ground up development or rehabilitation of a property. There's different markets that you can invest in, different property types. So you have all of these distinct attributes: investment thesis, location, property type, management intensiveness, etc. And what we found is the best way to really start screening those options, so you're not looking at this whole wide universe and being overwhelmed with that, or perhaps just as potentially dangerous, is not looking at all of your options and focusing on just what it is that you know and you're comfortable with and you've done before, because that may not be most consistent with your objectives either. So instead, we take a step back and we say, let's talk about liquidity needs and income needs and estate planning and how that is impacted by a transaction like this. Let's talk about how much time you want to spend managing property. Do you enjoy being directly involved, or are you on the other end of the spectrum and saying, I've done this for decades, I'm tired, I have no desire to continue managing in any capacity, I just want to collect a check. Let's look at your risk tolerance and how you view diversification and what sort of balance do you want between income and appreciation potential. These are the factors that are very, very important to give thought to, flesh out in conversation, and then ultimately put on paper so that there is a criteria in place. And now replacement property options can be evaluated within that lens. When we talk about distinct property types and distinctions between properties, rather, what I mentioned before was investment thesis, ownership structure, property type, geographic location. Those are all unique attributes among properties. Focusing specifically on two of those categories today, we have property type, ownership structures, and then property types. And that's a good lens to start with, to start to figure out within those two categories, what is most in line with what it is that you're seeking to accomplish. But also understanding that with the 1031 exchange, there's nothing that says you cannot acquire multiple replacement properties. So it's common for property owners to mix and match different options for themselves. So they're creating a replacement property portfolio that is custom to their objectives. From an ownership structure standpoint, there's three primary forms of ownership. There's ownership at the bottom of the slide here in fee simple property. That's what likely everyone here is familiar with, whether they know it or not. And that's the acquisition of a property or ownership of a property where you own the entirety of the property. You may still have debt on the property, or it may be in a closely held entity like an LLC with a business partner, siblings, or something to that effect. But it's a small ownership group or an individual or couple that owns that property and makes all the decisions for the property and is responsible for all of the benefits and burdens of managing that property. The other two structures that you see at the top of the slide, the Delaware Statutory Trust and the tenant in common, those are ownership structures that allow for fractional ownership, whereby instead of owning the entirety of the property, one owns a piece of the property. And why someone would consider that is because this is really the ownership structure that's intended for that individual who's saying, I want to be hands-off now. I may still want to make decisions as to what I'm investing in and when I'm investing, but as it relates to the day-to-day boots on the ground property management or even the asset management, which would be defined as capital budget, the leasing strategy, deciding ultimately when to sell that property and make improvements to that property, et cetera. They don't want to be doing that any longer. And maybe they want to diversify among multiple different property types so that they have investments that aren't quite as correlated with one another. But the Delaware Statutory Trust is really intended for that particular profile. It also allows for people to access significantly higher quality property, given the fact that there are multiple investors that own that property together. So we can go up to institutional quality properties, which we would define as properties that you would typically see being held by the likes of a life insurance company or a real estate investment trust, a REIT, a pension plan, university endowment, et cetera. The tenant in common ownership structure, very similar in many regards to the Delaware Statutory Trust, but with some key distinctions. And I'd say the primary distinction being the fact that any major operating decisions for tenant in common ownership require unanimous consent among the investors. So all of a sudden, when you look at having to get unanimous consent, we're talking about intentionally narrowing the number of investors down, and doing so in a way where, as a result of that, the investment minimums tend to increase as well. We will use tenant in common ownership clients that are looking for something that is going to be much more actively engaged from an investment thesis standpoint, involved, whether that's re-tenanting broken retail or doing extensive multifamily value add or something to that effect. But less commonly is it used for more of that stable, predictable income stream of a property type that it's already leased up and it's performing, and investors are coming in to then own that property for the foreseeable future. And then, as I mentioned before, fee simple ownership is likely how everyone who's joining today owns their properties, unless they have some DST investments or tenant in common investments. And this is a very, very wide tent. All the risks, but also all the rewards of property ownership. You do it all, or you outsource to third-party property management, but you still have to oversee third-party property management. Very commonly, individuals are concentrated in a particular property type in a particular geographic market, say owning multifamily or residential single-family rentals in LA County or whatever that may be, which is not necessarily a bad thing. That's a great way to develop an investment thesis and a skill set and an expertise and grow one's overall portfolio. But it does have a certain risk profile associated with it, and it is a lot of work and it's management intensive. But knowing that is always an option. And when we look at exchanges that are occurring, there are options whereby a fee simple property may make sense, say, for instance, exchanging into a single family rental that is eventually going to be repositioned to be your primary residence, or a vacation rental that's eventually going to become your family's second home. Property types are equally as important when we talk about the distinctions and how they behave differently from one another in market cycles. All property types are obviously not created equal, and they have their own unique dynamics that are in play. Say, for instance, multifamily, hospitality, student housing, senior housing, self-storage, those are all short-term lease properties where rents are adjusting on an ongoing basis, really typically no longer than a 12-month lease signed for any of those properties. So you have the ability to capture and adjust for inflation in those properties. The counter argument there would be expenses are typically borne by the owner of the property as opposed to the tenant of the property. And so expenses can also increase with inflation. Long-term net lease properties, net lease retail, industrial, medical office, whatever it may be, there the tenant may be bearing all of the expenses, and you have a long contractually obligated lease that should provide very stable, predictable income, provided that tenant continues to lease the property. And often there's not early termination clauses. So it really comes down to then the financial wherewithal and solvency of that tenant. Are they going to continue operating as a business entity for the term of the lease? Because if that tenant leaves, now all of a sudden that property is worth significantly less. That's a distinction between long-term lease properties and short duration lease properties. But when we start talking about demographic trends, migration of people, a surge in travel and hospitality, when we're looking at how supply chains are being restructured coming off of COVID and the impact that has on industrial, all of these factors have reasons why they either may support or be a headwind for respective property types. And one of the nice things about a 1031 exchange is, especially using a structure like the Delaware Statutory Trust, that ability to diversify among property types so that you have exposure to different opportunities and don't have all of your eggs in one basket. What we have here is a couple trends that we're seeing play out throughout 2023. That fairly quickly, just given what we have left in terms of time. The intent of working with an exchange advisor and why we see it being a very accretive relationship to have, adding value to the transaction, is that perspective and that experience having walked alongside property owners to determine what those objectives are, to ultimately design an exchange strategy that's going to allow that property owner to move from where they are today to where they want to be. And to make sure that throughout that process, the tax code's adhered to, the other advisors who may have a vantage point that is unique to their position, their CPA, financial advisor, the broker, estate planning attorney, that they have a seat at the table and are part of the conversation as well. And then ultimately that transaction's done in a smooth and efficient process. So it's really determining first where one wants to go, then how do you get there, and then executing on that. For those of you who may be interested in seeing some DST properties, one of the ownership structures that we mentioned, that's a form of ownership our firm works extensively with. You can visit our website and go through the AOA partner member hub that we've created, and that's re-transition.com/AOA. You'll see that there's a marketplace link there that will show you illustrative examples of properties that have made it through our firm's due diligence process. Additionally, one of the opportunities that we like to make available, and I think we enjoy just as much as those that take us up on this, is a free consultation. We are always happy to have a conversation with the property owner to answer any questions that they might have as it relates to 1031 exchanges, tax implications. You can walk through what would be the tax liability if you were to sell a property. I'm talking about concepts like estate planning, liquidity, etc. And then getting to know your situation and discussing replacement property options that may be a good fit for you if an exchange makes sense. We also have some online resources available, 2 guides specifically, first of which is our guide to understanding 1031 exchanges, and then also our guide to investing in Delaware statutory trusts. Either of those can be downloaded on our AOA hub. Excellent resources. As you can see, one's about 25 pages and the other one 27, but something helpful to have saved to your computer so that if you have questions, you can refer to that. But you can also always pick up the phone and give us a call or schedule a consultation with one of our advisors online. And then webinars are a near weekly occurrence. We focus on a number of topics, some broad, some narrow. So make sure to stay tuned for upcoming webinars, both through AOA, and then we have recorded webinars on demand available on our website as well. Lastly, for those of you who may have missed it, that AOA hub, where we've taken all of our educational information and really filtered it down to what is applicable exclusively to California multifamily and residential property owners. You can find that hub at re-transition.com/AOA. Well, Jeff, that is all I have on my end, and got some frequently asked questions we can do, or we can toss it over to your side, and if anyone hasn't submitted any questions, we can field those as well. Looks like you're on mute, Jeff.
All right. So yes, if now's the perfect time for you to submit a question if you have one. And again, that website, it's re-transitions.com. Is that right? And then /, then /AOA.
Exactly.
And so definitely check that one out for sure. And let's see if we have a question. I don't see a question yet. Doesn't mean that it's not in the pipeline, but let's go ahead and what was some of those frequently asked questions that you had?
Certainly. Okay. So first question we have here is, how long do you have to hold property in a 1031 exchange? And this is a question that commonly surfaces when looking at that strategy of, if I exchanged into, say, a single family rental, and I want to eventually make it my primary residence, or I want to make it a personal use property like a vacation home. There, it's advised that you have reportable income from that property for at least 2 tax seasons. So when we say at least 2 tax seasons, does that mean you need to have rented it out for 24 months, or do you need to just show rental income in 2 different calendar years and the duration doesn't really matter? Well, there's room for interpretation there. But a conservative CPA tax preparer would say rent it out for 2 years following the exchange, and then you can use the property however you please. There's no limitation on it at that point. Next question we have here is what is a REIT? And a REIT is a real estate investment trust. It's an acronym for that. And that's also a form of ownership that allows for individuals to acquire institutional quality properties, but unfortunately not via a 1031 exchange. Now, there are advantages to having REIT ownership, and one of the primary advantages being the fact that you can buy and sell shares when you please, this concept of liquidity. And you can use tax-deferred dollars in order to invest in a REIT, 1031 exchange dollars, but there must be an intermediary step. There has to be a step in between the sale of your property and the REIT investment. And what's done is what's referred to as a 721 UPREIT structure. I know we've shared on that concept with AOA before and done a presentation focusing on it, but effectively what that is exchanging into a specific DST property that is intended to then be absorbed by a REIT, thereby ownership in the DST then converts over into shares in the REIT. So those investors now own shares in the REIT as opposed to a percentage of that DST property. How much does it cost to complete a 1031 exchange? It's really not a very expensive process when we talk about the exchange itself. Now, you're selling investment real estate, so there's going to be traditional transaction costs there, title, escrow, brokerage, to just actually sell the property itself. But when we look at the exchange, most exchanges cost anywhere from, say, $1,000 to $3,000, depending on the number of properties sold and properties acquired. Most qualified intermediaries, which is the entity that will hold the exchange proceeds on behalf of the investor while they're performing the exchange, will charge a flat fee for the sale of the property and then a variable amount based off of the number of properties that are being purchased. How do I find DST properties? The best way to do that is by reaching out to a group like ours and having a conversation about, one, what our due diligence process consists of. I think that's a great place to start. Learning more about that. And then from there, we absolutely can share properties that have made it through that due diligence process, so that you can see whether, as an actual candidate for an exchange that you may be in the process of, or if an exchange may be coming up in the future, or if you're really just working to educate yourself right now for illustrative purposes. We're always happy to share those properties that have made it through that process with you. Should I identify replacement properties before I sell? This can be difficult to do given the fact that most sellers of those replacement properties are not going to be interested in you placing their properties under contract or tying them up before you have sold your property. They typically are not proponents of contingent sales unless you are offering them a price that is well beyond what they would normally get selling to a third party who could close in a traditional timeline. That being said, I do think that it's important to know, and this is really the intent of today's presentation, what type property you're going to be investing in. Understanding what the ownership structures are going to be, what the property types are going to be, what markets you're going to be targeting, what the return profile looks like, having gone through that discernment and evaluation process that we were discussing today based off of what your objectives are. All of that should be done before you even really make the decision to sell your property, much less actually close on that sale.
Hey, Austin, we do have a question here.
Sure.
from Moon Global Foundation. So
Okay.
thank you for the question here. Here we go. Can you talk about advantages or disadvantages of exchanging properties out of California that have state tax and don't have state tax like Nevada?
Mm-hmm. As a California resident, California is going to tax all income earned both in and out of the state. So what I mean by that is, even if you were to sell investment real estate and exchange into a non-income tax state, Nevada, Texas, Florida, Washington, to name a few, you are still going to have that income be subject to California state income tax. If you exchange into a state that has an income tax, such as Arizona, then really the only difference is who's getting those tax dollars. So Arizona gets to take their tax first, and then California will apply their tax rate on top of that. But you get a credit for the amount that you paid to the state in which the property was located within. So when we look at the actual tax dollars paid by the investor, whether the property is located in an income tax state or not really does not make a difference. Now, you can make a strong argument, though, that it does make a difference in terms of the growth prospects of that state and ability to attract employers and thus then employees and the demographic trends that result from that. That's not across the board, right? It's not to say like every market in Nevada and Texas and Florida and Washington are great markets to invest in, but that is a common theme that we see for the non-income tax states. I mean, that's a very compelling and unique benefit of living in a state like that and establishing your business in a state like that. So no actual savings from the investor side. It does save a little bit of reporting headache in terms of not having to generate another state tax return if you're in a non-income tax state. But really it's about the markets themselves and whether they're a growth driver. Now, if you move to a non-income tax state, or you already live in a non-income tax state, then you're looking at a scenario where, if you're invested in a non-income tax state as well, now we're talking about actual tax savings.
Mm-hmm.
Yeah.
All right. Hey, we do have a few more questions here. Could you stop sharing the slide thing and we'll get so we can see you a little bit better?
Sure.
There we go. And here we go. The next question, just on the tax part of it. There's George on YouTube. Please explain recapture of depreciation and how much is recaptured after performing a 1031 exchange.
Okay, excellent. So the concept of depreciation recapture really comes from the fact that when you purchase an investment property, the IRS says every property has a certain useful life. For anything that's residential in nature, single family rental, multifamily, et cetera, they say it's 27 and a half years. That's the table, the schedule that they've developed. For commercial, industrial, storage, retail, office, whatever it may be, it's 39 years. And when you acquire a property, every time you purchase a property, there's an allocation done between the land value and the structure value. So we'll just walk through a simplified example here. Say you purchase a property for $1 million and say the land value is $200,000 and the structure value is $800,000. And let's just say that's a duplex. And so it's a residential property. You now can take a tax expense every year for that $800,000 structure value spread out over 27 and a half years. So you take that 800,000, you divide it by 27 and a half. This is the concept of what's called straight line depreciation. And you now get an offset to your income each year for a 27 and a half of 800,000. Now, that benefit helps to shelter your income from being subject to federal and state income tax during the years in which you're owning it. And it's based off of your original purchase price of the property. Eventually, when you sell that property, let's say that property that you let's say you owned it for 30 years. So you went and used all that depreciation and you bought it for $1 million, but you're going to sell it now for $3 million. When we look at that tax liability and how it's calculated, the increase in value from $1 million to $3 million, well, that's all subject to capital gains. That's appreciation. The amount of accumulated depreciation, that 800,000 of depreciation that you took over the first 27 and a half years, that is the piece that is taxed at depreciation recapture. And what the IRS is saying is you receive this benefit each and every year, and now we're going to recoup that, if you will. Now, you don't have to pay it. You can do a 1031 exchange and defer both of those taxes. But what's interesting is the capital gain tax is graduated. It's taxed at either 0, 15, or 20% at the federal level. Depreciation recapture, the benefit a property owner received from it really depends on what their marginal tax bracket was. Sheltering $1 of income is much more meaningful for someone who is in the 37% marginal tax bracket than it is for someone that's in the 12%. But the IRS doesn't take that step of saying, we're going to look at what tax bracket you were in when you took your depreciation. Instead, they just say, we're going to apply a flat rate of 25% on all of that accumulated depreciation. Now, when you do a 1031 exchange, you can defer that tax, as I mentioned, and if you have any remaining depreciation left in your property, you can carry that forward as well. So you can continue to benefit from depreciation. And if you acquired more property than needed to satisfy your 1031 exchange requirement, say you sold that property for $3 million and you did an exchange, but you bought $4 million or $5 million of property for your replacement property, now you're adding new depreciable basis as well that will increase the annual offset that you get. Those tax concepts are a lot easier to put up on a whiteboard, Jeff, than to talk over a webinar, but hopefully that helps to solidify some of the concepts.
Great. And Helen on YouTube, did you say that I have to hold the exchange in a DST for 2 tax seasons? Can I sell out of a DST in 2 years? So I think a little misunderstanding there.
When I was talking about the 2-year hold period, that was more within the context of if you were to repurpose a property that you exchanged into to become a primary residence or a vacation home for you. When we talk about the DST, I mean, if you were to exchange into a DST property and then wanted to exchange into a different property, yes, you would definitely want to hold it for at least 2 years. But you can sell it before that if you're electing to pay tax. You don't get to choose when that property is sold, though. The sponsor will ultimately determine that. And on average, the hold period for DST property tends to be about 5 to 7 years. But if you elect that you wanted to sell your individual ownership, then there's a process in which to do so. And if you were to elect to sell your individual ownership and you wanted to exchange that again, I would very much encourage waiting for 2 years.
Great. So Helen, hope that answers your question for you. Here's Mario. Any thoughts on a reverse 1031 exchange? A client of mine bought a duplex last year, which he's thinking of selling and applying the sale proceeds to a new duplex he just bought.
There's a place for them without a question. They logistically are a little bit more complicated, but not terribly so. I will say that if he's already bought that duplex and he's thinking about doing a reverse exchange, that ship may have already sailed. He would have needed to have purchased the duplex knowing he was doing a reverse exchange, because there's certain requirements as to how title is held, and technically you would have needed to have used a qualified intermediary to purchase that property on your behalf. You fund it, you lend the money to then have that property purchased, and then you sell your other property and effectively pay off that loan that you lent to the qualified intermediary. They're a little bit more expensive. I think I had mentioned earlier that a typical 1031 exchange might be in that $1,000 to $3,000 range, whereas when we look at reverse exchanges, it's commonly in the $5,000, $6,000 range. But there is a place for them. We're not seeing them be as necessary right now as they were 2 or 3 years ago, because the velocity at which property is being sold is not as fast as it was in 2020, 2021. But there's certainly an available option, a tool to use.
Great. Well, Austin, thank you so much for sharing with us your wealth of opening up the treasure chest and sharing with us out of there all of your experiences and everything. Really appreciate it.
You're very welcome, Jeff. I always appreciate the opportunity.
All right. Well, next time we meet, it's going to be March Madness.
Well, looking forward to it already.
All right. I am too. Okay. Well, thanks everybody. Next week, man, we got 3 different live streams this Saturday. If you're in the LA area, maybe I'll see you. And on Saturday. Anyway, thanks everyone, and we'll see you around. Okay, Austin.